Your bank sent you a renewal offer and they already know you're going to sign it. More than 1 million Canadian families will open this kind of envelope in 2026. Most of them will sign in under 5 minutes, and that will cost them between $300 and $500 every single month for the next 5 years. This video gives you an exact 4-step playbook to locking the best rate before your bank even sends the letter. And step 4, the one question your bank is betting you'll never ask out loud, change the entire negotiation. 60% of all Canadian mortgages are up for renewal between 2025 and 2026. Most of those families signed in 2020 or 2021. Back then, 5-year fixed rates were around 1.5 to 2%. Today, the same mortgage costs between 4 and 5%. For a typical $400,000 balance, that is a payment increase of $300 to $500 per month. To put that in family terms, that is swimming lessons, piano lessons, and the summer road trip gone every month, simply because you sign up the wrong line at the wrong time. According to a 2025 FP Canada study, 42% of Canadians say their money is their number one source of stress, ahead of health, relationships, and work. And financial shocks like sudden mortgage hike do not just hurt the budget. In my experience working with families dealing with financial stress, I have seen how financial pressure quietly rewires the whole house. But here is the difference between a car breaking down and a mortgage renewal. You can see this one coming. That is the entire point. Here is how the trap works. By law, your lender must inform you of your upcoming renewal within 21 days. 21 days, that's it. Most families get the letter while they are already in survival mode. Work, kids, bills, the house. The letter offers a new rate. It looks official, it has a deadline, and honestly, signing it feels like checking one more thing off the list. But that letter is not your final rate, it is an opening bid. The rate in that envelope is called the posted rate. It is a number your bank advertises publicly, and it is almost never the best rate they can offer. The best rate? You have to ask for it, out loud, in writing, with proof that another lender is willing to beat it. Most families never ask. They sign, they move on, they lose thousands. I know this feeling firsthand because I have been blindsided by a financial shock I didn't see coming. Last November, our heat pump broke down. It cost around $5,000 due immediately. That was the moment I realized we had no financial floor. The money we thought we had was already spoken for. We had no choice but to pay, and it took weeks before we could breathe again. That was an unexpected shock. I could not see it coming. Your mortgage renewal, you can see it coming. That is the entire difference between that November and right now, when I stopped treating the renewal like an interruption and started treating it like a project I could manage. That is when we went from feeling powerless to having actual options. Here is the first option most Canadians never use. Most major Canadian banks allow you to start your renewal process up to 120 days early without any penalty. RBC, TD, Scotiabank, CIBC, BMO, all of them. That means if your mortgage renews in July 2026, your window opened in March, right now. The tool you use in that window's a rate hold. Think of a rate hold as the safety floor under your future payment. You lock in Today's best available rate for up to 120 days. If rates go up before you sign, you are protected. If rates go down, you ask for a lower one. The bank cannot say no. Then you do one more thing. You call a mortgage broker before you call your own bank. Brokers shop multiple lenders at the same time. They work for free and they often access rates the big banks simply do not advertise publicly. Once you have a competing offer in writing, not verbal, in writing, you are no longer a passive customer, you are a comparison shopper with documented options. It changes everything. But using the right window is only half the decision. The other half is what you sign. In 2026, the 5-year fixed rate offers stability, but it is also a golden cage. If you need to break that mortgage early, the interest rate differential penalty can cost you $10,000 to $30,000. That happens when you sell, refinance, or move. The 3-year fix is currently priced lower. It is a bridge, protecting you today while leaving the door open for the next rate cycle. Here is how I think about this from a family planning angle. A 5-year term says, I'm certain I know what the next 5 years look like. But anyone who has a child around 2 years old knows you do not know what 3 months from now on will look like, let alone 5 years. Maybe you move for a job, maybe the family grows, maybe someone gets sick and you need to refinance. The 3-year keeps your option really open. It costs less to exit and it costs less upfront. I'm not saying 5-year is wrong. For some families, that stability is the right call. But for families where the next 3 years are genuinely uncertain, the shorter term is the smarter move. So you have locked in your rate hold, you have your competing offer. Now comes the move that separates the passive signers from the one who negotiate. Most people think that negotiating a mortgage means walking into the bank and saying, "Can you do better?" That does not work because the answer is, "This is our best offer." Here is what does work. You walk in or you call with a printed competing offer and you say these exact words. "I have been offered 3.7% by another lender. I will prefer to stay with you if you can match or beat that rate. Can you?" That's it. No emotion, no apologizing, no asking if they might consider it. You are not begging, you're presenting documented leverage. 9 times out of 10, they will match it or beat it because losing you costs them more than giving you a better rate. And if they say no, you take the other offer. No penalty, no guilt. This is how you treat renewal like a negotiation instead of a formality. But here is one more layer most families miss, and it is costing them thousands without them ever realizing it. The bank is not the enemy, but they are not your friend either. They are a business, and their job is to maximize profit within the limits of what you will accept. Your job is to know what you will not accept. When you signed that first mortgage 5 years ago, you were grateful just to get approved. You took what they offered you because you did not have any leverage. But renewal is different. You have paid them on time for 5 years, you have built equity, and you are no longer asking for permission. You are choosing where to take your business next. That shift from passive acceptance to active choice is what changes the renewal from a financial shock into a financial reset. In my experience working with families dealing with financial stress, the hardest part is not the money itself. It is the feeling of powerlessness. The conversation that stopped happening, the tension that nobody names, the decision made from fear instead from clarity. This envelope does not have to be that. It is an opening offer, and now you know the 4 steps to answer it properly. 1. Start 120 days early. 2. Lock in a rate hold. 3. Get a competing offer in writing. And 4. Ask for the best rate out loud. The bank was betting that you will not use this playbook. Now you have it. As your renewal notice already arrived, drop the month it's coming in the comments. I'd love to know how many of you are going through this right now. And if this gave you one concrete thing to act on, drop a like. It helps other Canadian families to find this before they sign. Keep living frugal, stay free.